If I told you that the stop that you place in the market is needed so that the bigger fish can trade, how would you feel? Would you believe that? One of the first things that we're all told about trading is that without having a stop in the market, you are basically one trade away from a blown account. Now, our protective stop, it's vital to managing our risk, and to trade without one is really account suicide. And I don't think there's much doubt in that statement. Stops are a unique order type in that they act as limit orders sitting, just waiting to be filled at a set price, yet they're executed as market orders. Market orders, being filled at the best available price, are prone to slippage, especially in thin markets and those that are extremely volatile. Once triggered, stops have an important function as they add liquidity to the market and at the same time use the liquidity present in the market. So how is this important? Depending on how you trade, knowing this information is really crucial to preventing slippage that can give you an unacceptable average price. Get the average retail trader on the same side of the big fish, allow you to trade for some really quick profits, and allow novice traders to pay you. This picture here shows a common stop placement. But what does every trader hear? Place your stop just below the swing level of the move. Now, the reason behind this is that that level has been identified as an important support level. So what else is in the area of support? Buy limits for those who have identified the support area and are waiting to trade the retest of the zone. Now, does every area have a large amount of stops underneath? Time frames and how fast price leaves the area on the buy gives an indication. Now, the longer time frame swings will have more stops, generally, than a lower time frame. A pivot on a 60-minute chart can remain untouched, and therefore, more people can see it than on a 5-minute chart. The faster price moves away from the support area, for example, can show there's a heavy interest at that price point, or at least a bigger imbalance, and therefore can equal a greater quantity of market participants, larger positions, and ultimately more stops. Look at this chart here. As price comes down to this level, traders are interested in long positions, but this time, price is not rocketing away from the level as we would expect. It's not breaking lower, but lower highs are being printed. If you were interested in a long position right now, what would you do? The average trader is playing a support bounce and has bought the market, placing stops just below the support zone. If you have a limit order that is not yet filled, I would pull that order. If you're waiting for a time to market in, sitting on your hands, it's a good idea. Number one, lower highs are being printed. Number two, price is not going up as fast as you would expect if that was a strong support area. Number three, you know that there are protective sell stops just below the area. So what happens next? Price pushes through the stops as those who are long have their protective stops hit, convert it to sell market orders, pushing price down. Even better, those looking to sell the break of support get short, but have to cover as price goes higher. It's even better. Those who originally were biased long and got stopped out, market into the long side, helping to push price up. Now what is this chart looking like? New stops are below the pivot, setting up a version of the movie Groundhog Day. What just played out will continue to play out over and over again, but just at different price points. So I hope you understand this concept of what I just outlined. It can be used many ways, such as participating in quick profits when stops are taken out. Now, I am not going to outline a specific trade plan because understanding the concept is most important. Applying your understanding to making your own trade plan makes it your own. You should find ways that this information can be of value. And for those of you that are quickly taken out of trades only to see price resume, this may have been an eye-opener.